We're here to talk about the Silicon Valley real estate market. Today is May 25th, and then we'll finish off with the Greater Bay Area. We'll explain these URLs near the end. We're going to look at active inventory. We're going to look at offers accepted, and we're going to look at the ratio between the two compared to their 10-year medians. What that means is we look past 10 years compared to the same week and then see where we stand today compared to that median. Then we move on and we look at days unsold inventory. Days on unsold inventory is a measure of the speed of the marketplace, the supply-demand ratio. We then move on and we look at days on market. And instead of looking at the median and average, which both have a negative, we look at the 75th percent. We then look at days on market, the time to sell. We then look at seller price adjustments. We then look at overbidding. Then we look at long-term appreciation. And then we look at the sold price as well as not only the median as everybody follows, but the 10 and 90 percentile. And finally, the estimated payments, assuming an 80% loan. So let's dive in. Here's the active inventory in purple. You can see that have had a shortage of inventory, but it's been growing. And we're currently right about 88% of where you'd expect the inventory to be. Offers, however, have also been below, and have been growing, but they're only at 82%. And consistently here, the offers have been below the level of inventory. That's the first indication. The restriction isn't in the number of inventory available, but the restriction is in the number of offers. And as a result of that, we actually have a slower marketplace than we typically do. That's the days of unsold inventory up here in the gray line, and you're above 100%. So that's a slower market than you would typically expect to have. Yes, it's a fast marketplace, don't get me wrong, but it is slower than you would expect for this time of the year. This is the first leading indicator, and this is the time it takes the sellers, 75% of the sellers to sell, the time on the market, days on the market. And what we're looking at is the purple dotted dashed line is this year's data. And directly underneath that, there's a blue dotted dashed line, which is a year ago. They're right on top of one another. So the market is in the same place as last year. But we'll start off a year ago, we'll jump a month at a time, and then we'll flip over at 13 weeks, 3 months to 12 weeks. There you can see you're bouncing around, and now you're going to start slowing down for the end of the year. There's the end. Now you're into January, and you're improving. Right now, there's very little movement. You're sort of at the plateau. That was the peak. And the last 5, 6 weeks has been slowing down. So you came up, you improved. The green line back here was the peak of the marketplace, and then you've been slowing down since that peak. This is a leading indicator, in my opinion. The first thing that's going to happen as the market slows is sellers are going to take longer to sell their property. Moving on to looking at the seller's ask price reductions. As sellers take longer to sell, they have more time to reduce their prices, so you'd expect more price reductions. Again, the green dotted dashed line is this year, and the blue dotted dashed line is last year, and they're essentially on top of one another. We'll do the same thing where we step through a month at a time, sort of a summer plateau. Now you're going into the fall. There's the bottom. Now you're coming into January. Now you're improving. You have one plateau early in the spring, and now you're at the second plateau. And right there is the peak of the market in 1, 2, 3, 4. We've had 4 weeks of price adjustments increasing. So we've had 5 weeks of longer days on market, 4 weeks of more price reduction. So clearly the market's changing. Now that we're going to move over and look at overbidding, just like you went 5, 4, 3 is what I expect on overbidding, but overbidding has a 4 to 6 week delay. So I expect another week or 2 before we start seeing overbidding come down. But here, the green dotted dashed line is higher than the blue dotted dashed line. So clearly the market is stronger with overbidding this year than it was last year. But we'll go back to last year and then step down. So you're down here, and now you're going to drop into the fall. Now you're coming up into the new spring, and you have this early spring plateau, and it's slowly climbing. And now you're at the late spring plateau, and there's no drop off whatsoever because the purple and the green line are essentially the same as the plateau. So in overbidding, there has not been an adjustment yet. Now we're going to look at the first component. This is active inventory. And on all of the following slides, the concept is the same. You have the thin blue line up here at the top, which indicates a lot of inventory, which would be a marketplace favoring the buyer. The gray is a neutral marketplace where you'd expect it to be, and red is low inventory favoring the seller. In the next slide, it's going to be the red and blue are going to flip. Red is always going to be favoring the seller. Blue is always going to be favoring the buyer. But with inventory, a lack of inventory favors the seller and a lot of offers favors the seller, which is why it flips. The key takeaway, though, is look at the purple relative to, say, the gray line. Here, the gray line is significantly above the purple line, and the distance separation here is a lot less. Or conversely, note the distance that is pulled away from the red hot marketplace. So we almost have normal inventory now. You can't have a marketplace restrained by inventory if you have normal levels of inventory. Additionally, come back here to 2020, you had less inventory at this time of the year, not significantly less, but a couple 10% less inventory. And we'll see that we had more offers are accepted. Or come back to 2021, this time of the year, which is going to be right here, halfway through second quarter. So what was that, 3 years ago, 2021, we only had 1,500 homes on the marketplace. And yet now we have something like 2,400 homes, 2,300 at least. So you have 800, you have a good third more inventory this year than you did in 2021. Here is that gray line pulled out straight, so you can see the inventory is compared to normals up here. So there's been times when it's been quite a bit lower than normal. Now flip over. So let's come back to 2021. It's halfway through second quarter. Look at that. We were selling 3,500 homes. So in 2021, remember I said you had less inventory than we have now by almost a third, and yet you have almost 1,000 more offers. Here you only have 2,500. Here you had a little over 3,500. So you had 1,000 more offers accepted on an inventory of 800 less homes for Silicon Valley. So clearly, we're not now in a restrained marketplace because you had more transactions in 2021 with less inventory. So I don't know how much clearer I can make that. And again, Silicon Valley is Santa Clara County, Alameda County, and San Mateo County. But again, what you have here is you have offers that have been low and it's been growing, but not growing as much as active inventory. Here's the offers pulling out that gray line and making it straight. You can see that it's been growing, but right now you're about 82% of the offers you'd expect to be. Here's the speed of the marketplace, and between either active inventory or the number of offers accepted, this is more important because this is what dictates the speed of the marketplace, how much pressure buyers are going to feel, et cetera. And in a free economy, basically supply and demand dictates future pricing. In a nutshell, you basically are pretty close to normal level of speed. Slightly cooler, so slightly longer market, slightly slower market, but pretty close to normally where you'd expect it to be. Here's the gray line pulled out, and you can see that you're about 117% of where you'd expect it to be. So clearly slower, but still a fast-paced marketplace. Here's the time on marketplace. Now, this is sort of interesting that even though the market is slower than normal, the speed on the marketplace is faster than normal. And those two almost seem contradictory, but one is the turnover and one is the speed. So what this basically is saying is 3/4 of this market's moving relatively quickly. And if I was looking at that 25%, it might be moving more slowly. But 3/4 of the sellers are selling almost as quickly as they can. We haven't really had a year where the line was hotter than this. You come back and yeah, you beat it by a couple days because right now you're at 14 days. You come back here and you were probably at 11 days, 12 days. So you can meet it by 1 or 2 days, but this is pretty darn close to the fastest you'd expect. The red line again is the 10%. And unlike the other data, you really don't see the data ever pulling significantly below the red line. Here's the gray line pulled straight, and so you can see that we're somewhere around 82% of where you normally expect. So sellers are selling homes about 18% quicker than they do, or 3/4% of the sellers are. Here's the seller price reductions. And this is almost interesting in the fact that sellers are selling quicker, but they're taking bigger price reductions. You'd expect to be up on the gray line here, and you're almost on the blue line, which would be the biggest price reductions you'd expect to ever have. Sellers are selling quickly, but are taking bigger price reductions. Here's the line pulled straight. So here you can see you're pretty close to the gray line. Here's the sellers now that are taking the largest 10%. So because it's a tight metric and 90% of the sellers don't do any price reductions at all for the most part, I'm ignoring those and only focusing on the sellers that are taking the biggest 10%. And here you can see you're just below the blue line. So you're taking bigger reductions than you would expect to be taking. Here is the gray line straightened out. And again, you're above, which would be a slow marketplace. Blue is a slower marketplace. So sellers are taking bigger price reductions. Here's the frequency of the price reductions. Frequency is right where you'd expect it to be. So not more or less common, exactly where you'd expect it to be on frequency, but those sellers are taking bigger price reduction. Here now we're looking at the buyer's overbid. So this is a lagging indicator because now we need to wait for the sold price. So delayed 4 to 6 weeks. You'd expect it to be on the gray line, but yet you're way up here. You're almost you're halfway between the red and the gray line. So more aggressive overbidding than you'd expect. That's buyers paying a higher percentage above the seller's ask price. Here's the gray line pulled out straight. And again, you can see that you're above by about 2.5%. So buyers are paying sellers 2.5% more above their asking price than they typically do at this time of the year. Here's the frequency of that overbidding, and you can see that it's higher than normal. Somewhere around 78% of the sellers are getting more than their asking price. That leaves less than 22% of the sellers getting below their asking price, because some sellers are going to get at their asking price. And in order to be in this 78%, you have to be above your ask price. Here's the frequency pulled out straight. You can see that you're above, so more frequent overbidding than you typically would expect for this time of the year. Here's your long-term appreciation. The straight sloped line is long-term appreciation, and the purple line is the current data. You can see that end of the year holiday dips down every year. Yes, 2021 and 2020 were exceptions. 2020 was sort of a U-shaped, and 2021 was, the market was so hot it was basically flat. The rate of appreciation overcame the end of the year decrease. And the end of the year decrease is predictable not because price values actually go down, but because the type of homes that are being sold and the areas that are being sold, the median price actually changes. Here's the estimated payments, and this is for all of Silicon Valley. So the blue down here is the cheapest 10% home, would be about $7,200 a month payment. If you buy the typical home, you're about $13,800. And if you bought the most expensive home, you'd be about $27,000 a month. But those that are buying the most expensive homes are not typically doing so with an 80% loan. This is an interesting chart in the fact that the bottom line, our current offers accepted now is only 2,482, so just under 2,500. Our lowest year was 2014 in the year 2020. But 2020 was the pandemic, so we weren't able to show homes. I use a 5-week moving period instead of monthly data. So if we're taking today's data and going back in the rearview mirror for 5 weeks, we're including part of April when we couldn't even show homes. Once we get past about June 15th, then this data will be, 2020 data will be free-flowing data, and I would expect it will actually then be a higher number than our 2023. That's a long-winded way of saying, even though we're in second place based on the numbers, in reality, we're selling fewer homes this year than we have in any time in the past 25 years, except the pandemic. Now what we're doing is going through the same type of slides, but now instead of looking at Silicon Valley as a whole, we're focusing on the 3 counties, San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. And Alameda County has the most inventory as it typically does. The order here is basically the long-term normal. Yes, there were some years where Santa Clara County had more inventory than Alameda, but that was more the exception than the rule. Offers accepted. Here, the order's been changed because if you come back here to the left-hand side, 2014, 15, 16, 17, all the way up to the pandemic, Alameda County was selling more homes, offers accepted, than in Santa Clara County. Now the order's reversed. Santa Clara County is selling more homes. That's a fairly new, because even in, first couple of years out of the pandemic, they were essentially on top of one another. So it's only been since Alameda County has done this dip down here, which was a little unusual, that there's been a separation. So halfway through first quarter of 2024, Alameda County took a hit and has been doing the same slope. So it's lower by the same amount. But bottom line is Santa Clara County is now the county that's selling the most homes in any given period of time, followed by Alameda County. And San Mateo County is last, but that's a smaller county, so you'd expect that. Here's your speed of the marketplace. Santa Clara County is the fastest, so its supply-demand ratio is the tightest. In Alameda County and San Mateo County, it look like they're tied. I can't distinguish the difference between the two. Right about 37 days. So just over a month and a week, you'd be selling all your homes at the existing rate of sales. This is time on the market, related but slightly different. Here you can see again, Santa Clara County is in first position, the fastest position at 13 days. Then you have San Mateo County coming out here at 15 days and Alameda County at 16 days. It is sort of interesting that their days on sold inventory was equal, but there is a slight difference on the 75th percentile on days on market. Here's the magnitude of price reductions. They're pretty close together, but the San Mateo County has having the biggest price reductions, followed by Santa Clara County, which is a little interesting because in the previous slide, Santa Clara County had the fastest time on the marketplace, but the sellers are doing more price reductions than in Alameda County that had a longer time on the marketplace. Here's the frequency. San Mateo County and Alameda County are tied for second place, and the most price reductions are happening in Santa Clara County. So when I say tied for second place, it's actually a race if you're the seller, you want to be second place. Or maybe another way to say it is Santa Clara County has a little bit more common price reductions than the other two counties. Moving on to the overbidding. Alameda County has the most percentage overbidding, followed by Santa Clara County, and San Mateo County has the third worst. So even though the most activity is happening in Santa Clara County, the most overbidding is happening in Alameda County. And these are the kinds of differences. And this is at the county level. The micro markets that we're getting to show you at the 20 different micro market areas. Here's the frequency of overbidding. The most common overbidding is in Alameda County, followed by Santa Clara, and the least common overbidding is in San Mateo County. Here's the long-term appreciation. Santa Clara County's had the most appreciation at 110% appreciation, which means you've more than doubled your money in basically less than a decade. In San Mateo County, you've gone up about 98%, so you're not quite doubling your money. And in Alameda County, you're at about 85% appreciation since 2015. Here's your long-term pricing. You can see that San Mateo County is basically right at its previous peak, which happened back in 2022. Santa Clara County is above their previous 2022 peak. Only Alameda County remains below their 2022 peak. What I think this really says is Alameda County went up the most as a result of the short-term duration of COVID, and then people are starting to have to go back to work, so some of that distance is a little too much for them to do even a couple times a week. Here is the same information on regular paper. I have not adjusted the horizontal lines on this one, unfortunately, nor the vertical scale, because I believe this is off the top of the scale, because I think I'm at 22,350,000 or something like that. Here's your estimated monthly payments. This is assuming an 80% loan, reasonable estimate for insurance and property tax. And you can see that San Mateo County is the most expensive at about $19,000 a month payments. Santa Clara County is next at about 15,500, and the most affordable is Alameda County at 10,500. Here's the actual individual numbers for you, whether it be Santa Clara, the county, San Mateo, or Alameda County that you're interested in, or the overall marketplace. But your takeaways are your inventory is decreased in every county except for San Mateo. And the San Mateo County increase is actually a little bit of a surprise. Going into the holiday, I would have expected less inventory, as is Santa Clara County and Alameda County. The fact that San Mateo has more is what the surprise is. Active inventory overall is down in every county except for San Mateo County. It's up by 6 homes, so it didn't sell quite as much because it's only got 3 more new listings, so it lost 3 sales. Offers accepted increased in all counties. Alameda County seeing the biggest increase, followed by San Mateo, the next biggest, and Santa Clara, last place, for an overall increase of basically 6%. Silicon Valley basically saw 9% more offers being accepted. The speed of the market improved by 2.8 days overall, just about 3 days faster. And when I said improved, that's a faster marketplace. So sellers are selling quicker, buyers are feeling a little bit more pressure. You can see the price reductions that sellers are taking, and you have to subtract this from 100%. So in Santa Clara County, it's 0.7, 0.8%, and 0.5% in Alameda County. Here's the micro market area. So here you can start seeing what's happening in a given micro market area. Here, consistently, red is favoring the seller, the blue is favoring the buyer. You can see for active inventory, there's very little blue. It's almost all neutral. So you have basically the expected level of inventory you'd expect. Basically, normal inventory is between 87.5 and 112.5%. So 12.5% of either side of 100, I'm considering to be normal inventory. So typical inventory plus or minus 10% is what I'm considering to be balanced. And that's basically what you have. You basically have a balanced marketplace. You can see you got a shortage of inventory down in Saratoga, Los Gatos. You got a surplus up here in the San Mateo County coast, and the rest is pretty balanced. Now we look at offers accepted. Here, there's a lot more blue, especially up in San Mateo County. It's got the most blue. I would almost say Alameda County's got the next most blue, and Santa Clara County is doing the most normal. Normal would be good for the seller, which is why it's white in color. Blue, lack of offers, is not, it favors the buyer. There's less competition. Days on sold inventory is the speed of the marketplace, the supply-demand ratio. Fairly normal with some exceptions. Saratoga, Los Gatos is hotter than normal, with only at 58% of where you'd expect it to be. So it's selling almost half the time you'd expect. The San Mateo County coast is almost 300, so 3 times longer to sell. So you don't want to be selling in the coast area. If you want a good buy, you might want to go look at the coast. North San Mateo County is almost 200%, which is 100% slower, so double the speed. Alameda County and most of Santa Clara County is a balanced marketplace. Now we're looking at just days of unsold inventory. So this measure is sort of just the speed of the marketplace. Instead of comparing it to normal, I'm simply saying, where are we? And I'm saying anytime you can sell in 1 to 6 weeks, that favors the seller. Selling from 6 to 11 weeks is sort of a balanced marketplace, and over 11 weeks is favoring the buyer. The only area over 11 weeks is the San Mateo County coast. You can see the speed of the Silicon Valley, no matter what area you are, is moving pretty quickly. This is time on the marketplace based on the 75th percent. You can see most of our sellers are selling in under 2 weeks. I consider under 3 weeks to be a strong seller's marketplace. Here's your price adjustments. Again, red favors the seller, so you're having fewer price adjustments in the outlying affordable areas. Most of the valley is blue, is clear in color. There's a few areas that have a slight shade of blue to them. I almost would have to pull them off the legend here. San Mateo County coast, Los Altos, Palo Alto. It's really hard to see the blue with the background. Unfortunately, I don't have a white map to background this on. Fremont is the area where sellers actually raise their price, and that does happen. Sometimes it's a mistake. Sometimes listing agents want to raise their price to cut down the amount of demand or reflect the offers that actually came in the door. Here's the frequency of price reductions, so not very common, so it favors the sellers. The biggest number I'm seeing right off the top of my head here is at 21%. So less than 1 in 5 sellers are taking price reductions, and most of these areas are less than 1 in 10. So that's a pretty strong marketplace, which is why it's red. Here's the buyers now coming in with their overbidding. Again, most of the areas are experiencing overbidding. The only area that's a negative number is the expensive areas. So even though the San Mateo County coast was taking 3 times longer to sell, it's still getting a 1.4% overbidding. Here's the overbid frequency. So how common is overbidding? So even though San Mateo County coast was having a overbidding, it's not very common, with only a third of the sellers getting more than their asking price. My suspicion is, and didn't look at this detail, is it's a small geographical area with not a lot of transactions. So one seller probably got significantly above their ask price, which pulls up the average. Because, typically with 1 in 3 sellers getting their overbid, you're not going to see that number being that high. But again, most of the areas are red in color, favoring the sellers. Here's your long-term appreciation. Here, color is simply what areas favored the seller, the owner of the property the most, so had the most appreciation. So you can see that some areas have had a doubling, because here I subtracted off the 1%. So 100% appreciation is doubling your money. So most of Santa Clara County has doubled their money. Sort of surprising, Cupertino Sunnyvale is only 80%. Now it's possible that back in 2015, when I took my base year, that was inflated and that was upside down now. But it's different than most of Santa Clara County. And then San Mateo County is significantly lower appreciation, and that's to be expected. Basically, since the pandemic, the areas that were close to work centers became less valuable, and people were willing to tolerate longer commutes because they didn't have to do it so much. So the outlying areas with longer commutes appreciated more, and whatever areas appreciated the most recently tends to appreciate the most overall. Here's your sold price, and instead of following the median only, which is the middle number, I sandwich it with the cheapest 10% that you'd expect in the area and the most expensive 10%. So you know the price range in each one of the geographical areas. And again, red is the more expensive areas, pink's sort of in the middle, white's the absolute middle. So Fremont and Cupertino or Campbell are sort of the middle of the marketplace at right about $2 million. Maybe 1.9 might be the median. There's 3 that are very close together: Fremont, Pleasanton, and Campbell. And if I was to guess, it's going to be between 1.9 and 2,038,000. So probably about 1,925 would be the median for the whole Silicon Valley. Here's a summary of what we went over. I sort of highlighted that at the beginning, but now it's just for reference since we just went over each individual areas. It also lets you pick something like the San Mateo County coast and come across and see how you have blue, and the fact that price adjustments here is red indicates that I probably need to make this adjustment a little more restrictive on what my criteria is. That's one of my newer metrics, so I'm not have had the data to fine tune it yet. Here's sort of some of the differences that I find in my data versus everybody else, and some of the key points. I won't read the slide. You can come back and you look at it if you're interested. Now we're going to leave Silicon Valley and talk about the Greater Bay Area. We're going to talk about the Greater Bay Area by looking at 5 regions. The first region is Silicon Valley, but then we're going to add in the cities, which is San Francisco, Marin, North Bay, Central Valley, and the Central Coast. Here's starting off with the data in the reverse order, so you can pick whatever county you're interested in and then compare it to whatever metric it is that you think is most important. Here's the inventory. You can see inventory has been growing in all 5 regions. Here's the number of offers been growing in all 5 regions. Here's days of unsold inventory. So here's the speed of the marketplace. So Silicon Valley is the fastest. Then 3 of your regions, the North Bay, the cities, and Central Valley are very close together and basically tied for second place. And the slowest market, as it typically is, as you look back over this graph, is the Central Valley, Santa Cruz and Monterey. So it's the slowest. And when I say the slowest, it's about 70 days to sell its inventory, days on sold inventory. So in Silicon Valley, that would be considered to be a balanced marketplace. Time on the marketplace, here there's a little bit more differences. Silicon Valley is in first place, was coming in at about 14 days to sell for set 3/4. So 3/4 of your sellers in Silicon Valley are selling in 2 weeks. In the Central Valley, they're taking 22 days. And in the cities, they're taking 24 days. The North Bay is taking 30 days, so right at a month. And the Central Coast's coming in slowest at 31 days. Here's the price reductions. Silicon Valley is taking the least, followed by Central Valley, followed by North Bay, followed by the Central Coast. And San Francisco and Marin are actually taking the biggest price reductions, and it's been hit hard since the pandemic. Now we're looking at the frequency of price reductions. Silicon Valley has the least price reductions, with only 1 in 10 sellers reducing their price, followed by the sellers at about 14%, then Central Coast. So even though it's one of the slowest and taking a long time, it's only selling about 17% of the sellers are doing price reductions. You go up to the North Bay and it's a little over 20%. And Central Valley is doing the most price reductions at 22% of the sellers doing price reductions. Here's the overbidding. So even though San Francisco is doing the most price adjustments downward, it's getting the most overbidding. And it could be that they're adjusting their price to the point where buyers come in and overbid. But in any case, fairly recently, there's been a marked change. I also need to go back and check my data to make sure there isn't one property that's eluding me with an unreasonably high sale price, because that would pull up the average. And it does sort of look like it was a rapid run up. One bad data point disappears after 5 weeks, but I will go back and look at it before that 5 weeks. Then you drop down significantly. So San Francisco, Marin, and Silicon Valley are very close together, up here around 110 to 111% overbid. So it's 10 and 11% overbidding. Then you jump down to the North Bay at only something like 3% overbidding. Central Valley is somewhere around 1.5% overbidding, and the Central Coast is right at the seller's ask price. This is the frequency of overbidding. Silicon Valley now is outdoing the cities by quite a bit. It's at 78%, where the cities is only at 70%. This would tend to give indication that there is a property in the cities in either San Francisco or Marin where the sale price got reported wrong. You know, maybe it sold for 2 million and they reported it at 3 million, and I didn't catch that. But I will go back and see if I can't find it now that I know that's an issue. Then you have the North Bay at somewhere around 55% of the sellers getting more than their asking price. Central Valley at 54, and the Central Coast at only 42% of the sellers getting more than their asking price. I say for only 42% in this Bay Area. That is a pretty low number. It isn't a low number for the Central Coast, nor is it a low number for pretty much anywhere else in the country. And you can see that all these numbers are up above where we were before the pandemic. Here's long-term and total appreciation. I'm using the last 9 months of 2015, so April of 2015 through December of 2015. Silicon Valley's gotten the most appreciation, where it's now about 205% of what it was in 2015. So that's 105% appreciation, followed by the Central Valley at 192%. Then the Central Coast at 82%, North Bay at about 78%. And in last place, the San Francisco Marin that I commented on was getting hit hard, is at only 50% appreciation. And notice if you come back here, prices are upside down since 2021 in the cities. There is no other micro market area that it goes back that far. If you look at Silicon Valley, it's above its previous peak. Central Valley is close, and Central Coast is somewhat close, but below. North Bay is basically very close. So the only one that's really upside down is San Francisco and Marin. And it basically had 2 big spikes, but it's been basically flat since the pandemic. Here's the sold price. You can see Silicon Valley is getting very close to the cities. And you can see how much vertical separation there was historically on the left side of the map here. And you can see there was a period of time when it was Silicon Valley was actually higher than the cities. Right now, they're very similar. And basically third place by itself is the Central Coast, followed by the North Bay, and followed by the Central Valley. So Central Valley is the most affordable area. Here's your fixed payments. The interest rates have been dropping a little bit, so that's pulling it down a little bit. And you can see the different data points here. They've all rolled down. With that, I'll answer any questions in a minute, but this has been about Silicon Valley real estate market, May 25th. Then we ended it with the Greater Bay Area, 13 counties and 5 regions. My YouTube archive channel is this blue. If you want less typing, just type in tinyurl.com SVREM for Silicon Valley real estate market, the underlined letters. If you want to join us at Saturday morning to ask questions or just hear the live presentation, you just type in the green root URL and add in 2024. If you want the handout, you add in H 2024, the year, month, date code, so 0525, the date of the presentation, and it is posted. I got it up about 5 minutes before 9, and any particular episode. I'm Richard Calhoun with Creekside Realty. My contact information is here and on every slide. Let me see if there's any questions. Not seeing anyone unmuting their mics. Have a great week. Take care. Bye for now.